What about you? How are you playing this into this market? Because again, it is the holding period, and this month is going to be really crazy in terms of news. You're going to see a lot of crazy stuff because it looks like we're going into recession too.
Yeah,
official recession.
Of course, the Feds have done a good job. Jerome Powell, chairman, has done a good job of, in my opinion, signaling what he's going to try to do. So I haven't looked at the most recent percentages for the rate hikes and things. If they don't do 75 at the end of the month, I think it's the 27th. If they don't do 75 basis points and then hint at another one, the meetings actually, the minute meetings come out today, Frank.
Yeah, from the
later this afternoon. Mm-hmm. And they should be very hawkish.
Yeah.
And hopefully they're hinting at 75 basis point hikes this month and next month. And then they're going to signal that pause. Now, total coincidence that there's a midterm election. We'll get to that later in a minute. But to your point, it is working in the sense of I'm just not sure on how quickly that's going to turn into it. It's this buy the rumor, sell the news type deal. So you point out many times, if earnings come out, the majority of results are based on guidance. Hey, this company can report a great earnings per share number and beat, but if they lower for the second half of the year, stock's probably going to go down. It'll be wild to look at this, the Fed meetings today, the minutes, and the Fed meeting coming out later, because what if the recent pullback, and you're exactly right, oil, food hasn't gone down yet, but gas prices are drifting lower, copper is drifting lower, all the metals are drifting lower. But what if that doesn't show up in the upcoming numbers? And if it doesn't, that may not matter as much because people might interpret and say, well, they're just not baked in yet, but based on oil going from 130 to 98, based on copper prices dropping, based on everything else going down, lumber, the reaction still might be a positive. Does that make sense?
It will make sense because you have to factor in, right? We have to factor in, Daniel, is that a lot of these stocks are getting hit. They've got hit already, right? So now expectations are low. We're so used to, over the past 12 years, the majority of the past 12 years, let's say since 2010, where expectations are pretty high. And when they're high, you have to meet them. You have to beat expectations. That's why you've seen a lot of buybacks in stocks with artificially inflate your earnings. There's ways to manipulate your earnings to go higher, not, legally through companies. That's what happens when you report every quarter, which you really don't need to do, but, whatever. It's good for trading. When I'm looking at earnings right now, I want to see if it's factored in because right now earnings expectations have been lowered for Q2 where they're expected to grow at 5.6%. A lot of that's going to be from energy. But when you look at Q3 and Q4, what would you think? Would you think the earnings are going to be higher or lower from 5.3% this quarter?
I think they should be lower. They're probably projected to continue higher, though.
Okay, not just projected to continue higher. Q3, they're expected 10%, and Q4 is expected 11%.
And this is year over year, right?
This is year over year growth, which is, when I see that and those numbers, I just think they're relatively high because of the uncertainty, right? Just China. China came out today, right? When it comes to the uncertainty down, they came out today and said, look, we're more COVID cases, so you might see further lockdowns. So there's a little bit of a scare in China right now. And again, we know it's supply chain concerns and they're the growth engine of the world. Who knows? I mean, we have Biden going over there to tell them, or I don't know if he's going there to just lower tariffs. I think he's meeting with OPEC or whatever, but, they're going to start, dialing back on the tariffs and stuff like that. Again, just for relationships with China, whatever that means. But China has been outperforming our markets. But I know that further lockdowns, Macau, I saw they closed one of their casinos due to COVID outbreak. It makes sense that they might close a lot of those casinos now. So the uncertainty out there is really tough where you have these companies. And also, if you look at Russia, what we did with Russia is when we took them off SWIFT payments, that was a huge deal. That was a big deal. It means basically we can't do any business with them. I know it's through the banking system and stuff, but it forced every single company to not do business with Russia anymore. And I think that wasn't really factored in because you're looking, especially through oil, right? We have a lot of business with oil. Not that we do a ton of business with Russia, but there are a lot of companies. Even Netflix reduced their earnings. They would have been, not earnings, their subscriber growth would have been positive, but it was negative. It was still down tremendously, but the negative number was because of Russia. So everyone's eliminated those Russia operations to take it right down. Exxon took a big write down, Chevron, all these companies. It's going to be interesting to see how they beat going forward, especially with the uncertainty with energy prices. And we'll go through that in a minute. But those expectations are really high. And we want to see when they report that guidance as a CEO. When you look at the CEO and you look at the sentiment of CEOs, and I have this because it really surprised me, the CEO confidence index, it was 8. So it's on a scale from like 1 to 100. It was 80 in 2021, very, very high levels. I think almost record high levels, close. But It's at 40 now. And at this level, at 40, just to explain to you guys, it only gets this level during recessions, where you look at 2020, 2010, 2000. That's when it was at these levels, a little above 40. So for CEOs to have that little confidence, I don't see them coming out and being aggressive, which is a good thing, because now's the time to be conservative. You could be conservative and get away with it because your stock is already down. The anticipation is that they're not going to be great. So all you have to do is really meet earnings and you're going to be okay. And maybe, maintain your guidance and your stock's probably going to go up. Maybe it goes down a little bit, but I want to see if it's factored into these stocks, because I think this earnings season is going to be a little rough, and you're going to separate the winners from the losers within industries. It's not going to be all cloud companies go higher, all, consumer cyclical companies go high, all the airline. I think you're going to see massive separation within those industries of companies that are getting it done and companies aren't. And it's going to be really cool. It's going to be a stock picker's market. I'm looking forward to earnings season to see what these guys say.
Speaking of CEOs who have a glass half empty outlook, did you see Meta's Mark Zuckerberg, formerly Facebook? He was saying how things are going to be terrible, and he was getting out in front of that and saying there was going to be either further layoffs or some people may end up leaving without having to be quote unquote fired. That's all fine. How to play it? Like I said, I hope the Fed comes out and they are very hawkish in their meeting minutes today, and then everybody prices in. What's interesting to me is that there are a couple rate cuts, as soon as the first quarter of next year, Frank. Mm-hmm. So we could have a rate hike this month, another rate hike, a pause in September, and then a cut. Now, what's interesting, and I forwarded you this just real quick here, and I know numbers are hard to follow and it's goofy. The reason I think the Fed is right to try to raise quicker, more fast, by 75 basis points, even if they came out and surprised by 1, it would be a terrible knee-jerk reaction for the stocks. But they got to give room to start cutting. Mm-hmm. And if you look at up to 2020, and this is why I think they've painted themselves into a great corner. Fiscal year 2020, the height of the coronavirus stimulus mania, the debt on our national debt of 30-some trillion was relatively low. It was only, I say only, using my best Austin Powers quotations, 6% of roughly the 6.8 trillion outlays. Now, it was about a little under 400 billion in interest payments, debt services. Now, why is that? Well, because interest rates were artificially low. If you scroll down, and I don't know if you have it on your side, but if the Fed keeps hiking and we get to 5%, why am I picking out 5? A 5% average rate would mean that the service on debt is the single biggest annual expenditure for Congress. It would be higher than Social Security, which is what? 1.2 trillion. Medicare, 826 billion, and the Department of Defense of 704 billion. Mm-hmm. In my opinion, and I know deficits don't matter. That's a great quote from former Vice President Dick Cheney. At some point, why do I bring this up? Because at some point, you're going to see a lot of headlines about the interest and the debt and people getting worried. That's going to be good for gold and Bitcoin, in my opinion. Mm-hmm. We need to see that break away. But I just think the Fed needs to be aggressive and start raising so that they can only back off. And I think, and we've talked about this in the past, it's okay to sit on the sidelines or at least be scaling into certain positions right now. We can get into a couple of those in a minute. If the market starts pricing in a rate cut or Powell hints at anything early next year, coupled with the midterm election, regardless of how that goes, you're going to see a massive rally, in my opinion. So yeah, we're in waiting mode right now. I think the markets are going to drift lower between now and the end of the year. But again, I think it's smart to build your watch list and start buying in. And I've been wrong up to this point as well. I mean, I've been buying it here and there across oil and crypto and things like that, and they're still going down. If you want to stop the conversation right there and say, well, you're wrong, so therefore I don't want to listen to you, that's fine. But the world's not ending, and you want to prepare for what's coming, and this is what's coming ahead, and it'll be great to see the Fed minutes later and then see what they actually follow through with.
Yeah, I think when people run into debt, it's a fantastic story. Debt is only a concern when you see companies and people not being able to pay it off. Or that's when people can't pay it, that's when it's a concern. You're not seeing that along the banks. The banks are stronger than they've ever been. They're buying back stock and they're raising their dividend because they're forced to keep a lot of cash on the balance sheet and not lend it out, right, due to the new laws. But when you have to look at both sides, right, you say both sides of the balance sheet or whatever it is, it's really a balance sheet when you're looking at income. So we look at both sides, those interest rate payments. You're not going to see 5% of the Fed funds rate. It's pricing in right now at about 3%. Maybe 3.2% on the Fed funds rate. And we could be there very, very quickly. We could be there by September. I don't know if we're going to be there by September, but if you're looking at debt servicing costs, interest payments, and Canaccord has a great report out with great charts on this showing that interest payments are around, $550 billion, right? That's where they're going based on the current interest rate. But nobody talks about this. Is the revenue that the government is bringing is $3.2 trillion. Okay. So, that interest payment, yes, you have to be concerned if we go much, 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 much higher. But at these levels, it seems like we're topping out. With the 10-year at 2.8, it went to 3.3 and not going higher. That surprises me. It tells me that the Fed, it's pricing in that the Fed is pretty close to being done after this next rate hike at the end of the month. And that's why it's going to be interesting for the Fed, because they don't want to sound dovish because, it made them look really, really bad, like a bunch of idiots. By being dovish and always painting that picture like, oh, we might only do this. And this is only a couple months ago. Mm-hmm. This is a couple months ago when they started raising, they were like a 25 basis point hike. And they were trying to be, kind of like, it's not going to be that bad. And finally, the Fed said, okay, inflation's out of control. We need to do something about it. And for people to believe that we're not going to hit a recession is naive, right? Because the Fed doesn't care about a recession. The Fed cares about bringing down inflation. That's our biggest threat. The quicker that comes down, the better shape we'll be. And we can always lower rates. But when they're at zero and you're seeing and low and you're seeing inflation out of control, that's when you get back into a corner. You can't do shit about it, right? There's nothing you could do. So they're actually forcing a recession. They're doing that. They're taking money out of the system.